To welcome you to a kind of an annual event. We have, again, thrilled to welcome John Kutchey, who is the East Region Director for NCUA. For those of you who may not know me, my name is Ron McLean. I'm the CEO at CCUA. And this session today is essentially an opportunity to hear from NCUA leadership about the 2024 exam priorities, and then ask some questions. So a few questions came in that I'll ask when that time comes. I do encourage our members to submit questions via the chat function. You will be on mute, and when the time comes to come off mute, please do so, and we'll go from there. So I do want to share, before I introduce John, just a few association updates. I'll be very, very fast on this. So coming up this Wednesday, 11 o'clock, we have a new network. We have a technology network. The first meeting is this Wednesday at 11 o'clock. We have a strong attendance for that. So if you or anyone on your team has an interest in technology, our new network should be a great opportunity to learn and engage. We're meeting with John today with NCUA. A quick reminder for our CCUA membership that we have our compliance hotline. We have League Info site. We have CU Policy Pro, great online and virtual compliance resources for our members. As far as events go, we're going to blink and we'll be heading down to GAC to attend America's Credit Union Conference, the Keynote GAC. We have 130 of our membership attending a GAC, which should be fantastic. Briefing, hike the hill, networking, socialization. We are going to have a CEO meeting with NCUA Vice Chair Kyle Hoffman on Monday. We'll do our briefing. Should be a great couple of days down in DC. April 4th, we have a CEO roundtable in Waltham that normally attracts 40 plus attendees. Great engagement for our CEOs. Also in May, we're going to take our CU Accelerate Conference south to Philadelphia. Really excited to bring that conference to our membership. It's a great city, great conference, and we hope to see you down in Philadelphia in early May. And then a little further out in June, stay tuned for a FinTech event called FinTech Connect. That's going to be in Southern New Hampshire, and just stay tuned for that event. So let me lower my voice, and I'm going to hand it over to, again, John Kutchey, the East Region Director from NCUA. And then again, please submit any questions you have via chat. And we'll start with John and go to Q&A. John, it's all yours.
Ron, I think we may have lost him.
Thanks, Fred. Let me give him a quick heads up.
Looks like he's logging on, back on now.
I should tease him. We should put in the NCAA budget and a new PC for him. Yeah, give him a quick second.
All right, you got me, Ron?
John, we lost you. You came back. I can hear you. Let me try and find you as far as your audio, your video.
I got that too. And you should see me now.
Looking for you on my screen. There you go. John, you're all set, and welcome back, and thanks a lot. And John, it's all yours, please.
All right, so this is what happened. See, Ron, you gave an update, and I tried to move my screen from one side to the other, and I clicked sign off, and I was gone.
Okay,
so,
no problem, John. No problem.
Anyway, hey, good morning, everyone. I always appreciate the invitation from Ron and his team to come and talk to you and give you some thoughts and ideas and some perspective of NCUA. So I always have to start with this disclaimer that what you're going to hear are my opinions and not necessarily those of the NCUA board. But from my perspective, the examiner staff and the supervisory examiners and the people that you talk to at NCUA to do your business work for me. So you probably would be interested to know the thoughts and what I'm telling my staff and team as they come in to see you and do your exams and supervise you and have conversation on product and services. So this morning, the agency issued the last week or the week before our 2024 supervisory priorities. So I'm going to use that as kind of a jumping off point to talk to you. But before I get into the supervisory priorities, I thought I'd give you a kind of a snapshot of what we're seeing globally across the region and really across the agency in terms of trends in our operational model. So financial trends. Net worth is still the greatest piece of positive information that we have on the financial performance of credit unions. Net worth is super strong across the board. Now, obviously, this is going to fluctuate from credit union to credit union, but as an overall system, net worth is very strong. And as we say at NCUA, and as I tell my staff, the net worth is there to help on the rainy day. It's your umbrella, it's your raincoat. It's going to keep you from getting wet. And so sometimes you got to tap into your net worth in order to make it to the sunny days. And that could be part of your plan as I talk about the supervisory priorities, part of your plan to kind of improve the risk management of your balance sheet. So net worth is a strength. We're starting to see delinquency and charge-offs pick upwards across the industry, which is expected. If you sat in on any conversations I had on financial trends in credit unions in 22 and 23, you will probably have heard me say the next shoe to drop is going to be credit risk. And that's the shoe that's dropping now, is a little more stress in loan performance, which is sort of expected in difficult economic times. And that's kind of where we are. Return on assets is another area where credit unions are struggling at this point to either turn a positive profit, or a lot of credit unions at this point are in an operational loss mode, and we'll talk about that a little bit later as to why. Liquidity is still my primary concern in credit unions at this point. It's very low across the industry. A lot of borrowing going on to meet operating needs. Nothing that's going, in my opinion, going to cause a failure, but it's going to stress credit union operations with the flexibility or the lack of flexibility you have to move in and out of different products and services and increase loans and some other things you might want to do to improve profitability. And then interest rate risk is something that's still out there in terms of your balance sheets are still loaded with long-term loans and long-term investments that are yielding below market rates. And at the same time, you've got to increase your cost of funds to go through and in order to keep the deposits that you currently have in place. So if your assets are here and earning this level, your cost of funds was here in 22 and even early 23, and they're rising. They're starting to intersect with each other and squeeze your earnings levels. So that's a super high level view of financial trends in credit unions, but I want to get in. I'll delve into those numbers a little bit more as I talk to you about the priorities. So let's get started there. Liquidity risk, as I just mentioned, is still my top concern priority as a regional director. Here's what we see, and your credit union probably has some version of what I'm about to mention. So we look at a few different numbers. So you're preparing for your examiner to come on site and you're trying to gauge as to what we're going to look at and what we're going to see in liquidity. I'm going to give you a couple of calculations that you can do to kind of test where you are as a credit union. So one of the numbers that's on your financial performance report is a ratio of cash and short-term investments to assets. Traditionally, that number is in the 15 to 20% range for credit unions, meaning 1 in every $5 of your assets are liquid. Presently, that number in a great deal of credit unions in the region is below 5%. So meaning you have 50 cents out of every, no, $5 out of every $100 is liquid versus 20 out of every 100. The other challenge of that, so the second part of this calculation, so that's a number that's on your financial performance report. And what I have my examiners doing is taking that number and subtracting your borrowed funds level from it. Because a lot of credit unions are using borrowed funds now to fund regular operations. So if you take your cash and short-term investments, subtract borrowed funds from it, that's going to give you a net number. And that's going to tell us whether you can fund and sustain your operation without borrowing. A lot of credit unions, that number is negative right now, which means you need borrowed funds to meet operating needs. That's a higher level of concern for us as an agency versus a net positive number. So as you're trying to calculate what your liquidity risk might look like, use that. And then we delve one level further. We take your cash and short-term investments, subtract borrowed funds, and then subtract what we call volatile funds. So non-member deposits and other types of share products that you might have tried to pull in to generate more liquidity. Things that are not part of your normal core shares. And that'll give you a net number as well. A lot of credit unions are in a negative there. But again, the big one that I would kind of zero in on if I were you is your cash and short-term investments minus borrowed funds. Are we liquid within our balance sheet to be able to meet members' needs? And a positive number means you are. A negative number means you need borrowed funds to sustain operations. So as we do with most of the areas that we look at as an agency, the higher the risk you have in a specific area, the higher our expectations are for you for managing it. So we're not saying anybody's in danger of failing from these numbers or anything like that, but it means you should be implementing a higher level of review and management and control over your liquidity position. So one of the things my examiners will look for from you is some detailed cash flow projections. Are you monitoring your inflows and your outflows? And your inflows would be repayments that come in for loans, any level of share growth, your next payroll deposit grouping, what's that flow look like on a daily, weekly, monthly, quarterly, annual basis? And then your outflows, of course, to pay your bills, member withdrawals, funding loans. So you should be projecting that information. Again, the closer you are to zero, you should be projecting that information. So at any point in time, you come into a week and you should know where your high point is and where your low point is, and then fund accordingly. Do you have the opportunity and the means to fund your low point in the liquidity cycle? And again, that's on a weekly basis, a monthly basis. As you get into the quarter and get into an annual, the further you range this out, the more assumptions you have to begin to include. But those are the kinds of things that we're looking for from credit union management when your liquidity is super tight. The other thing I have examiners looking at, and the letter that came out to credit union sort of talks about your liquidity sources of borrowing. So where can you generate liquidity? And most everyone has at least one borrowing source. My suggestion, the closer you are to zero, I would have multiple options available. If you put all your eggs in one borrowing source and that borrowing source dries up for you, you're really left in a difficult position. So I'd have at least two, depending on your size and sophistication. I might even have three. Most of you have the Federal Home Loan Bank as a source. A lot of you have the Federal Reserve as a source. Corporate credit unions is another good one. And the central liquidity facility that NCUA manages is another good one. So there's 4 ways you can go to generate some borrowing capacity and potentially increase your capacity as you look at the different types of borrowing options you have out there. So that's liquidity. Again, that's the one that I'm most concerned with in the short term because it is pretty tight across the industry. And it's again, not at a dangerous level or anything along those lines, but we've seen some of the regional banks fail in 2023 over the inability to fund withdrawals. We don't see that in the credit union industry because you're not funding startup corporations and things, the places that these banks were funding with or they were depending on for stability in their deposit structure started pulling their money very quickly. I don't see that as a credit union issue as much because we're member based and we're individual consumer based. But it is something you just need to be aware of and that you're monitoring closely. So that's liquidity risk. My number 2 is credit risk, and it's a growing one. It's number 1 on the agency's priority list that they sent out to you, but for me at this point, it's number 2. Last year, this time, it was probably number 4, but I did signal last year that credit risk is the shoe that we're waiting to have drop. Because what happens when finances are tight, people have to start making choices about where their money is going. Feeding their family is always first. And then it comes down to which bills do they pay? Do they keep the lights on? Do they make their car payment? Do they pay their gas and electric? Or do they make their house payment? So those are the tough decisions a lot of people are having to make right now. Now, this is a weird conversation because normally we're sitting smack dab in the middle of a recession when we're having this conversation. If you talk to the economists in the world, we're not in a recession according to their statistics. But a few things that I monitor after 35 years with the agency that tell me what's happening in the world. I don't need necessarily an economist to tell me these things. I can see them for myself. So when you look at consumers today, a few things have happened. Cost to feed your family has gone up markedly over the last 24 months. Rent has been moving in an upward direction. So the basic things in life that consumers need to spend their money on has become a lot more expensive for them. Even though salaries have increased in a lot of areas and you hear that unemployment is close to an all-time low, doesn't necessarily mean a lot to me in terms of what consumers are doing, because one of the things that I track is how consumers are generating money to pay their bills. And the one thing that scares me as a regional director and a person in the industry is that credit card debt in this country is pretty much at an all-time level. The average credit card debt per consumer is at an all-time high. So what starts to happen is the finance companies, credit unions, banks, financial companies out there who are actually holding the credit cards are starting to tighten standards because they're starting to see increased delinquency and losses from them. And when that well dries up, I think that's when we have a lot more challenge in terms of credit risk across the industry, because it tells me that consumers aren't really contributing to the economy through their salary and earnings. A lot of them did it through generating credit card debt. And that well dries up eventually. And when it does, decisions on what gets paid become a lot more difficult. So that's a couple of the concerns I have with credit risk. Now, you might ask me, what can I do about it at this point? Because the loans are already on my books. So one of the things I kind of zero in on is looking at your collection programs. What do we have in the areas of collections? Are we staffed and suited to deal with an uptick in delinquency, whatever product line that is? And if you have enough to kind of get you through where you currently are, but you don't have enough for an increase or an acceleration in collections, that's an area that as a credit union you might want to look at as a short-term fix to the challenge. You also should be tracking your different loan products in enough detail to know where the stressors are in your balance sheet on your income side. I'm sorry, on your lending side. So take a look at your products. What's the performance in our mortgage loan program? Did we or do we have lower loan to value ratios? So we're protected there from an asset perspective if we have to foreclose on homes. How about our auto loan program? If you built an auto loan program that'll do a 7 or an 8 year auto loan and finance 125% of the car value, you got a much higher risk portfolio than one who stuck to maybe a 6-year term and required some level of down payment in the loan product, or no worse than 100% loan to value. So those are the kinds of things you should be monitoring now and making decisions on whether you might need to strengthen your underwriting on a go forward basis to offset some of the risk that you currently have. So that's a couple of things in the credit risk area that you can look at. One of the things that and again, if you heard me last year, you probably heard me talk about this. Real estate values is one of those areas that I'm a bit worried about as a regional director, because I think we're sitting on a bit of a housing bubble at this point. Now, I don't know exactly what that amount is, and every market has something different going on, but rates have been, our values of real estate have been going up at a crazy pace for the last few years. And a lot of that is due to the lack of supply. The lack of supply comes because people are sitting on 3 and 3.5% mortgages and don't want to either go buy something new because their new rate is going to be 6.5 to 7%, or they're not financially in a position right now to sell and upgrade their housing situation. So the lack of supply has driven up values. Eventually, we hit an equilibrium in the selling market. And here's what I think happens next. Rates, the world has been accustomed, the country has become accustomed to 3 to 4% mortgage rates. If you've been around long enough, you know that was an anomaly. A 3 and 4% mortgage rate is all-time low numbers. The normal is in the range that it actually is now. 6 to 7% is a pretty normal mortgage rate. There is a period of correction in people's thinking that goes on before 6 and 7% become normal, and people realize this is where the world currently is, and if I want to do something different in the house, I got to suck it up. The challenge here is values went up so high, rates are high, so people cannot afford mortgage payments right now if they actually refinance or they go and want to buy something else and upgrade. And that's part of where I think there's a correction coming in values, because we don't control rates, but the values will drop until payments get to a level that people can afford. So that's where I think there's some market adjustment coming in values as we go forward. Now, I said people become, eventually rates become normal. I don't know that we're there yet, but I think we're getting there. I think things are starting to loosen up a little bit. And if projections are right that rates are going to come down a bit in 2024, then people, 5% doesn't feel so bad. 5.5% doesn't feel so bad. So I think that will spark some increase in refinance activity and loosen up the market a little bit, which will give you guys a chance maybe to refinance some of your loan products, because right now you're stuck with your long-term real estate loans, as is everyone else. But eventually they'll hit a point where you can reprice a little bit. So that's credit risk, liquidity risk. I have on the list cyber risk. I'm not going to hit this one too long. This is the same risk issue that's been on the plate for close to a decade now at the agency. It remains a priority for us, but not a lot has actually changed or evolved in this market. Bad actors are out there trying to hack systems, but I have a few nuggets of information that might help you as you look at your program in 24 and beyond. So a couple things on the basic hygiene. For its systems that you own and control, patch management is probably the biggest thing that I can give you as a fairly easy thing to do and missed enough to make you vulnerable. So as your different systems with Microsoft and the other products that you carry, they issue patches to security risk periodically. You should have a regular routine of checking on those patches and making sure you or your IT department is upgrading those patches or implementing those patches to secure your systems as much as you can. One of the challenges that I see as a regional director is most of the cyber incidences that are reported to us by credit unions occur because of third-party relationships they have. It's pretty rare that we get a report of somebody actually hacking a system that you control and manage on site. It's usually because of a vendor relationship that you have that's been hacked that has a downstream impact on you. Whether it's someone who's managing your credit card portfolio or real estate portfolio, or heck, we've even got one recently where a company that was handling statement processing for credit unions was breached, and that caused a reportable incident to us. And probably the biggest one we've had so far occurred a couple months ago. The FedComp breach that impacted 60 credit unions and their core operating system. So they were not able to do anything for their members that wasn't done manually or through backup facilities for a period of a couple of weeks. So we actually had NCUA staff on site at credit unions helping them through this process, working closely to the extent that FedComp would share information with us, working with them on the resolution as well. But that was probably the biggest one we had. But again, that was due to not necessarily FedComp's management system, but even relationships that they manage with third parties. So this can make you dizzy if you start thinking about it. So you contract with FedComp, that's your third party vendor, right? Well, they're also contracting with other IT services to build their products that they're sending to you. So there's second and third layer impacts here on IT security that have an impact on you. And I don't know exactly where to tell you when to stop in terms of how far to look and what kind of questions to ask there, but it's something that's come to my attention and a trend that I see as an RD here in the East, where we're constantly seeing reports of third parties who've been breached, and credit unions have to report that because your member data is compromised as part of that. So not that I wanted to give you something to keep you up at night, but that's one of the issues you have in today's modern world of running a financial institution. Everyone's trying to hack our systems. Everyone's trying to hack your systems on a nonstop basis. And again, the basic hygiene, patch management is one of those. Running periodic vulnerability tests, potentially with a third party to come in, help you figure out where your vulnerabilities are, is another good hygiene issue that's pretty easy to implement. So that's a couple things on IT security.
Hey, John.
Yes, sir.
Yeah, a question came in as you're talking about the cyber stuff. So the question came in, what is the NCUA expectation, i.e. number of days for patching to mitigate cyber risk? Is there a certain kind of benchmark as far as every month, every few weeks, or maybe answer that if you don't mind?
So usually a third party will send you, it's just a sort, I'm gonna punt it here a little bit. That's a better question for one of my IT specialists. I mean, I would think you'd want to be checking at least monthly. And I would think, a lot of the vendors send it on a flow basis. As soon as they have something, they let you know an update is available. So it's really keeping an eye on that. And a lot of credit union, depending on your size, you're the jack of all trades in your credit union. You're responsible for everything. So maybe that's a little less frequent. If you've got an IT department, they should be looking at that stuff pretty much constantly. There should be sort of a daily review of your products and services, but it depends on the size of your institution and the sophistication of your operation. And again, the smaller you are, the less staff you have, the more multiple hats you're wearing. It's not necessarily realistic to expect a credit union to check daily or even, I mean, in my opinion, weekly. Maybe it's more of a monthly patch.
Thank you. Thanks.
Sure. The other one I have is interest rate risk. Last year, this was probably number 2 on my list. Now it's down as number 4 or 5. And I've sort of talked about this already when I mentioned earlier that a lot of you are having trouble generating profits right now. That's largely because of the interest rate risk that you've got in your balance sheet, not necessarily a fault of your own, the nature of the economy, right? For 10 years, real estate interest rates were near, or mortgage rates were at all-time lows. Your entire balance sheets have repriced down to these low numbers, 3.5%, 4% mortgages. So you're stuck with these now. Low cost or low rate auto loans is another big product in the industry that's out there that doesn't reprice. Now, a good thing is those are 5 to 6 year loans generally. And just by the nature of their short term, you're going to get those repricing. So that's not as bad as the real estate loans. So the more concentrated you are in real estate loan products, by the nature of where we've been as an economy and low rates, the higher your interest rate risk is going to be. It just is. And one of the interesting phenomena we saw in 2022, as rates started to rise and the Fed started to increase rates, credit unions in a lot of cases doubled and tripled down on the rising yields. Even though rates were projected to keep going up, a lot of credit unions locked in their investment portfolios very long term in the early to mid 2022 period. So you're sitting on a portfolio of low yielding real estate loans and a portfolio of low yielding investments at this point, both of which have a long-term nature to them. At the same time, you need to stay liquid. So you're trying to keep your shares in place, which means you're raising rates on products or offering alternate products to keep members with you who are looking for the higher yields at this point that they can get in other institutions. So your assets aren't yielding a ton more than they were a year to 2 years ago, but your cost of funds is rising. That's why earnings are declining in credit unions. And again, some of that has to run its course with the real estate values or the real estate refinances and the investments maturing. Now, if you're running really tight liquidity and you want to do something now to mitigate some of your risk, you have a couple of options as a credit union, as officials and board members. You have the opportunity to take a look at your asset structure, and are there ways to put some liquidity back into our balance sheet without borrowing? Pretty much all of those ways are going to cost you some of your net worth. But I'm here to tell you, if you're planning something to do that and you want to mitigate or reduce your liquidity risk, reduce your interest rate risk, turn some of your long-term assets into things that are available more on a cash and short-term basis, to offset that risk, you may have to take a hit to earnings and may have to take a hit to your net worth to do that. As NCUA, if you're looking to mitigate risk and it's going to cost you some of your net worth and you've planned for it and it's over a defined short period of time, we're generally not taking exception to that. If you're borrowing and things are happening just because and you're reacting to the environment and it's costing you earnings and net worth, those aren't necessarily seen as positive management actions, even though they're necessary. So I hope you can kind of differentiate between those two. But again, I started this whole conversation. Net worth is near all-time high for you guys. It's there for a rainy day. I'm not saying it's pouring, but it's drizzling. So if you want to stay dry, you might need to tap into some of your net worth and earnings in order to try and restructure some of your balance sheet and give you more flexibility. So that's one of the things in the interest rate environment that you might be able to hit. The only other thing I'm going to really hit, because I think Ron wants to get to some Q&A with you guys. So the only other thing on interest rate risk that I'm going to mention is something that we're seeing on a fairly wide scale basis. You know, you've got to manage interest rate risk, and usually that comes through some level of ALM modeling. One of the things we're seeing is the assumptions that credit unions are using are, in a lot of cases, showing and reporting to management that your financial position is going to be better if rates continue to rise. If that's the case in your credit union, you need to go back to your vendor and seriously question those assumptions. And part of what it is, it's, my opinion, it's overvaluing your shares in terms of them not being rate sensitive. So the lack of rate sensitivity in shares is what is making it look like as rates rise, your risk is decreasing. That doesn't make any sense in a regular world. But the things I just described to you with where your mortgage rates are, where your investment incomes are, if rates rise, your situation is going to worsen because your share cost of funds is going to have to continue to rise on products in order to keep your liquidity position, which is already tight. So what I'm asking you guys to do is kind of look critically at your ALM modeling to determine if it makes sense. Does this pass the straight face test to me as a CEO or a board member? If it doesn't make sense, then you need to question your assumptions, because that goes into one of the things I think a lot of credit unions are struggling with is your ALM modeling may show exactly what I just mentioned, but when we run our testing, which is a pretty crude model, it's very basic, our NEV testing and the stress testing that we do as part of our exams will show your numbers tanking if interest rates rise, and your numbers are showing things improving. It's that reconciliation of those two things, which is where a lot of conversation is coming in on examinations now. We use a much more conservative number at valuing shares. And to be honest with you, it's not that I'm drumming up or believing in NCUA's numbers, but the expectation that if rates rise, your situation is going to become more difficult is pretty much the way it's going to be. So again, if your results don't show that, you need to go back to the drawing board and talk to your ALM modelers on why that's the case and does that make sense to you. So that's kind of the last thing, Ron. I think you guys have some questions that came in advance on the consumer compliance area. So I'll save that as a risk discussion for the Q&A, and I'll turn it back to you.
Yep, super, John. Thanks for covering on the ground there. So again, to our members, feel free to submit any questions in the chat feature. We'll get to those. And then we'll give folks a chance to kind of come off mute at the end and ask any questions that way. But a couple of questions did come in advance of today's session. John, I did share that, some credit unions have asked about consumer financial protection, kind of noting that's been a Chairman Harper priority for a number of years. So what can our membership expect as far as consumer financial protection focus and energy by NCUA in 2024?
Great question, Ron. So it remains one of our priorities, which is in our supervisory priority letter. So Chairman Harper has made no secret that consumer financial protection is one of his core mission focuses since he has been an NCUA board member and has been our chairman. When you look at our 2024 budget, if you dissected it in any way, one of the things that you'll see is a shift in some of our resources in the regions, that we're going to take some of our safety and soundness examiners and move them over to consumer compliance specialists. Now, we haven't had a specific dedicated separate consumer compliance program since the early 1980s at NCUA. It's always been weaved in as part of our safety and soundness exam. So when we did an exam, you guys got everything covered, the safety and soundness part and consumer protection. You'll see that still in most of the credit unions that we do, but there's going to be an increased focus and possibility of individual examinations on just consumer compliance in some of our bigger institutions. That's where I see the program heading in 2024 and 2025. So that's a shift in the way we've done consumer compliance exams. Now, some of you may have already been subject to fair lending examinations by the agency. If you haven't, we actually already have a staff at the agency that do nothing but fair lending examinations for the agency. They issue independent reports and findings. Staff from the region, my staff, participate with our fair lending specialist, but I see a similar program coming into play that's going to be more generalized with consumer financial regulations in general. And I think that's what you'll see in later as we move later in 24 and into 2025.
Thanks, John. Maybe along the same lines, overdraft has been a big issue, throughout the system for some time now, including from the CFPB, which is certainly separate. But in your priorities, it does include an expanded review of overdraft, and again, just sensitive to our membership, how they're feeling on the pressure on the overdraft programs. What kind of extra focus will NCUA take in 24 regarding overdraft?
That's a fantastic question, Ron. I don't have a lot of detail on that one yet, though. What happens every year, just to walk you through our process. So our Office of Consumer Financial Protection puts together a consumer compliance review program that my staff reviews during the examinations, and overdrafts is signaled in this letter as one of the things that our Consumer Financial Protection Office is going to have us focus on during exams. I haven't seen the work program yet for it, so I don't know the specific questions and depth that they're going to go into with it. But the fact that it is signaled within the letter tells me there will be some specific focus. And you're like, wait a minute, John, it's already February, and why don't you have it running yet? We actually don't usually implement a lot of what's in this letter until the end of February. So exams that start at the very end of February and into March is when the new review program will actually be implemented. So we still have about a month to get with our OCFP and have them deliver the program to us. But again, I would expect some additional review in that area, but to the depth and exactly what that's going to be, I don't know yet.
Okay. Thanks, John. A question came in, a direct question from one of our members, and I'll kind of just read it back to the group and to you. Does NCUA see derivatives, in particular interest rate swaps, as a good option to help mitigate interest rate risk?
The answer to that is yes. Now, I am not an investment expert and I am not a derivatives expert, so I'll start with that. But when I talk to my staff who are experts in the area, one of the things they mention is that's a better program before interest rates start to rise. And that mitigation. So credit unions that were into derivatives and using them to hedge interest rate risk 2 years ago are reaping the benefits of that in their balance sheet now. Rates, I don't know if they've peaked or not. That's not one of the things I tend to not play, the interest rate environment. But since rates are already theoretically at their high point, entering a derivatives program now may be a very limited help to the credit union. Because I think one of the things, Ron, that came in when you shared a couple of questions with me is, if rates decline in 2024, what's the expectation for credit unions? What can credit unions do? So I'm going to give you guys what I've always lived with, my years as an examiner and risk management at the agency when it came to interest rate risk management. And this is what they taught us as examiners when I was brand new back in 1990, and it still plays today. Credit unions should not be playing the interest rate game in terms of trying to predict and then load up in one direction or the other in order to maximize profits, because the risk of that is extreme if you're wrong. What's always been told to us, and what I love as a philosophy, is you should build a balance sheet that works in both directions of the interest rate cycle. Now, will there be credit unions that outperform you in each direction? Sure. Credit unions that played the, hedged and expected interest rate risk to rise and kind of held off and now are reaping the benefits of that are producing at a really good rate. Most credit unions, again, their balance sheet refinanced, they're at all-time low rates, no fault of their own, it's just what the market was bearing at that point in time, but loaded up on real estate concentrations, are paying a price for that because rates did rise. What you want to do is have enough variety in your products and services that you can earn a reasonable profit when rates go up and a reasonable profit when rates go down. So I wouldn't put all my eggs into either one of the baskets and build, oh, rates are going to decline. And if they don't, you could really be doubly hurt by playing the downward direction. But it's also a very plausible scenario. But again, as you're looking at your balance sheet, look at balancing so things reprice in both directions as rates start to rise and rates start to fall.
Thanks, John. I have one more question that came in. I'll ask, and then we'll open it up. We'll kind of give people the chance to come off mute and ask a question. Again, if you would rather send the question via chat to me directly or everyone, please do so. I've already asked a couple of those questions, but John, this is kind of a new one that's come up in the past few months. So as credit unions get more into and utilize artificial intelligence, are there any specific recommendations that NCUA has? I think NCUA has mentioned in the past about be careful for any kind of bias in the algorithms, things of that nature. But again, as more of our members utilize AI within their shop, any specific guidance you'd like to share?
Yeah, that keeps coming up as a topic. So I'll start with a confession. The federal government usually isn't out in front on issues. We normally lag the industry, right? The product or the service starts, and then we figure out where the risks are. Now, we've built some offices in the agency, a fintech office and some other things that are closer to the cutting edge of things like cryptocurrency and AI than we ever have been before. But we really haven't delved, at least at this point at the regional level where I live, deep into AI and the impact AI can have. You hear all the benefits and what can be done to help streamline operations and help you control costs and do other things. But the thing as I give thought to this, AI is going to, if bringing AI into my operation, the thing that I would treat it as is if it were one of my employees. What's the impact of the artificial intelligence? Just like if one of my members was dealing, or one of my employees, humans, was dealing with a member, I'm responsible for that as a credit union. That interaction, what's said, what's not, they represent my credit union. Same thing with AI. You can't just cut it loose and implement it and walk away from it. It's something you have to manage and nurture like you do an employee. So that's really the thing I see happening now. And Ron, you kind of already mentioned, you're responsible for the results of AI. You can't, we've actually seen, unfortunately, a few credit unions run into some issues with disparate treatment of members in the loan approval area based off of algorithms and things that are developed and are sort of an AI in terms of they learn as they go and adjust the algorithm based off of results. And some of those algorithms produced loan decisions based off of protected classes of people. Age as one, marital status is one that's hit. So those are things you can't deny a loan based on, but some of these algorithms that went unchecked actually did those things. And the credit union's obviously fully responsible for monitoring and managing those results. And I think AI brings an extra level of complexity to that because the speed with which they can learn and control their environment is much better than any computer technology we've had to date. So it's fantastic. It's scary at the same time. But again, if I'm a credit union, I would think of it as if it were one of my employees. What would I do with that? How would I nurture it? How would I pay attention to it? What level of interaction would I have with it? And that's the best I got right now, Ron.
No, thank you, John. And I'm going to give a chance for our members to kind of come off mute. I'm happy to ask questions, but I want to give the courtesy to the CCRA board chair, Fred Reinhardt. I think, Fred, you submitted a question in the chat, which might be a nice opportunity to kind of engage our members to ask a question directly of John. But Fred, if you're okay to ask your question.
Yes, Ron, thank you. Director, thanks for joining us. We appreciate
Sure.
you taking the time for sure. Hey, you had mentioned during your liquidity discussion that credit unions were borrowing money to fund operations. And I was just curious about the definition of operations, right? Are you saying that there are credit unions that don't have enough income to pay their operating expenses and they've got to borrow money to meet their just general expenses?
So yes, those are rare, not a mainstream, but yeah, there's credit unions that are running so low on their liquidity level that they've made the decision to borrow funds. Now, take what I said and know that one of the things I said later on is credit unions are making conscious decisions at this point to absorb some of their net worth and take lower ROA to restructure the balance sheet a bit. So it's not that they don't have liquidity available to them if they make some hard decisions to take some losses to restructure and generate on balance sheet liquidity. But a lot of credit unions are finding it less expensive to borrow to fund regular cash needs than to actually make some of these hard decisions and generate more liquidity on their balance sheet. And that the tough part of that, Fred, is, we're missing not that there's a lot that the credit unions can do about some of this, missing opportunities to potentially grow some loans in this environment, because the first thing that most credit unions do when they have the balance sheet I just mentioned is they stop lending so they can build liquidity organically through, repayments come in. We're not generating new volume at this point. So that by its nature is adding to my liquidity position. So I don't know that there's any one thing a credit union can do to fix where their liquidity is. It's probably a combination of all of that. Maybe I tighten my lending standards for a bit so I can generate some cash for my operation out of loan repayments. That's probably the best one in terms of it not costing you net worth, but it also has to be balanced against some long-term impact, because if you're not generating loans now at current interest rates, your future earnings potential is harmed a bit. So there is a rolling process to balance sheet management there that needs to continue. So you can't completely cut off earning, or you can't completely cut off lending activity, but you can certainly curtail it until you've resolved your liquidity situations if you have one.
Okay.
Thank you.
Yeah, thank you, Fred. Thank you, John. John, a question came in on the chat. I'd like to ask, so NCUA's COVID relief expired mid-2023. From a regional perspective, if there's still some consideration on the impact of large asset growth on net worth during the audit process, the ability of credit unions to match that asset growth with income growth short-term strongly impacts that ratio, but doesn't necessarily reflect the actual health of the credit union, but could still affect a composite rating.
Yeah, so what we're actually seeing is a lot of the COVID money has flowed out of the credit union already. So we didn't think that, we've never been through a worldwide pandemic, right? We didn't know what was, the extreme growth that came in was unprecedented. And now one of the unknown questions is, now that we're past the COVID pandemic period, what does member behavior look like? And one of the things we're starting to see is members are starting to demand some higher returns because they're able to get higher interest rates on their savings accounts at different banks and other companies that compete with credit unions. It's very rare right now that we see a credit union that grew so dramatically during COVID and actually kept all of that. The ones that did keep it, most of them put it out into loans in 2022. And I think that was the phenomenon that we saw, because shares went up so dramatically in 20 and 2021 during the COVID shutdown, that once the economy started to loosen up in 22 and rates started to rise, then credit unions are like, oh my God, I was getting 0.01% on my investment up until today, and now I can get 1.5%. Let me lock that in. So we have a lot of credit unions and banks, by the way, that locked in long-term investments at what are now way below market rates, but they were way above what they were currently getting at the time of the COVID era. So there's positives and negatives to what happened with COVID, and most credit unions, or I shouldn't say most, a lot of credit unions have the challenges that I'm describing to you now.
Okay, thanks, John. And we're about 2 minutes away from kind of the top of the hour, if you will, and we want to start on time, end on time. I do want to give Lisa Dandino from Navigant Credit Union in Rhode Island a chance to make a comment she asked for. Lisa, all yours, please.
Thank you, Ron. And Director, I just want to say thank you. You have a great team. We have a good working relationship with Michelle McCarthy, Ryan Lim, and others, and I find them to be very good resources for strategic discussion. So I just want to thank you for that added value.
Absolutely. You mentioned a couple of people who are amongst our best. Michelle used to be actually one of our regional capital market specialists in another lifetime. So her knowledge of ALM, interest rate risk, liquidity is really, I depend on her a lot and her team for some information there and direction of what she's seen in the credit union. So thank you for that compliment. That's fantastic. I'll pass it along.
Yeah, thanks for sharing, Lisa. And we're at the top of the hour. I want to, John, thank you very much for once again, John, you've been fantastic in the past number of years. Kind of an annual tradition, I'll call it. We'll talk football pre-event, and then we'll talk about NCUA priorities for the year. But really want to thank you for your level of engagement with CCUA. You've been a strong partner for many years, you and your team. And to our membership, thanks so much for joining us today. And if we can help be kind of a facilitator of a dialogue with NCUA, please continue to reach out to us. And to everyone, have a great day and a great week ahead, okay? Thanks so much.
Thanks, Ron. Thanks, everyone. Take care.
Bye-bye.
Thank you.